we are.
Yes.
So you have nice view on the bus station. Okay, go ahead. The floor is yours for about, say, 50 minutes to an hour. So I leave it to you. Yep. Okay.
All right. Thanks, Martine. All right. Hi, everyone. As Martine said, we started out both in finance. I actually started out before that was at the Dutch Central Bank. So we were regulators and policymakers. And before that, I started out in finance. And then over the course of my career, I became a regulator, and my scope has broadened over the years. So I started with very complex financial products. Given my background in mathematics and econometrics, that's where I naturally ended up. And then over the years, my scope has broadened. So at one point, I was the Dutch representative in the Basel work stream. And then I ended up from going to Europe to the US and looking at the broader economy. And at this point, I've been looking at the global economy and global risks. So pretty big scope at this point. And I think I'm going to give you a very short, similar journey because I think it's important. And I think for the future of banking and being in finance to be successful, you have to have this bigger picture as well. So before we start, though, there's a quick poll, and I'll get back to this afterwards at the end. So you have a choice between two worlds. Everything is the same, prices and impacts, etc. And the first year you earn 150,000, and then the next 200,000, or it's the reverse. So you earn 200,000 now, and then next year you earn 150,000. So let me just get a quick poll. Martine, you would have to help me count because it's a little bit of a small screen for me. So how many people choose world one?
Two people yet. So anybody more? Three, four people? 4 people.
You included, Martine?
Just haven't made my mind up, sorry.
You'll have to participate as well.
I'm happy with world 2 because I'm not sure if my heart is still okay. So.
Okay, so we had 4 for 1, and then the rest is 2, which is a total of what?
1, 2, 3, 4, 5, 6. About that, so 4 versus 6.
All right, good. So we'll come back to that later. So first we start out with finance. And I started working a couple of years before the financial crisis, which was a real wake-up call. And some of the older people here will remember that. If you're a bit younger, you might have missed what an enormous impact it had, not just economically, but also just almost in terms of humility, because we really thought we had figured it out. We really were talking about the great moderation, and from now on, you know, we're not going to see much upswings, but also never. We've figured it out. We know how to stabilize the economy now, and then that happened. So we had, for example, a lot of smart people working at these big financial institutions that you all know. Citigroup, their model said that with 99% certainty, they would not lose more than $2.5 billion on their market positions. And then these were all the actual figures. So they were off by about $100 billion. So at that point, you know, I think you have to be intellectually honest and say, okay, clearly we've been missing something. And maybe that 99% certainty wasn't that certain after all. So after the crisis, loads of people looked into what it was causing it. And a couple of root causes there was leverage in the system. So basically high debt levels, which I will come back to later. But I think also a key thing that we haven't solved so much yet is that we were looking at risks and isolation. So, and Martine knows this very well, when you're a regulator, you have all these different kind of frameworks like credit risk, market risk, liquidity risk. And we didn't look at how these risks actually interconnect. So we managed them separately. And during the crisis, what you saw happening was really that these actually appear in clusters. So we had credit risk that first the mortgages, people started defaulting on them. That spread into the complex products, the securitizations. And then that caused losses on the positions. So that's market risk. So the credit risk triggered market risk. And then that spread, and we saw a little bit of contagion. And then that caused ultimately liquidity to dry up. So now you have liquidity risk. And when that happened, the economy grinded to a halt, which caused further credit risk. So you have this perfect cluster going on. And that's why the impact took everybody by surprise. And another root cause was that we were looking at these things with models that ultimately can only look back because they rely heavily on past data and past data only. So there were really quite a lot of people that had kind of a feeling that it couldn't go on like this, that it just couldn't keep rising and rising and rising. But our models told us that based on historical data, a risk was actually very low. So a lot of these models assume a certain constancy that, if you think about it, isn't very realistic anymore in today's world. For example, VAR, typically these kind of statistical models, they are based on, first of all, the constancy, the assumption that the past will continue into the future and that we can rely on past data only, but also normally distributed errors, constant variances, zero correlation, or at least a constant autocorrelation. And those kind of things aren't actually given in today's economy. And the reason I and some of my colleagues think that we made this assumption is because a lot of our models were actually created around here. This is where people started winning Nobel Prizes for them. And so they were tested on this data series of this period, which was an unusually stable period in time. It's actually not how it was for most of our history, for at least over the past 2 centuries. And one of the reasons that it was so stable is because we were not that interconnected. So if you see, these are the banking crisis, and this is this dashed line is the capital mobility, which I think is a proxy for how much we are interconnected. So we didn't trade that much here. This is not the case anymore today. Today we're more interconnected than ever, financially, but also in all other kinds of ways, technologically, socially, and environmentally. So the models that we really worked quite well on this data series don't work so well today anymore. So this is it's just an example. This is the idea of what an asset of a balance, a bank balance still looks like for a lot of people. So you have a bank and they take savings from people and then they borrow it out to other people who start shops or something. But it's not actually what we do anymore today. So today we're, again, much more interconnected in many different kind of ways. There's much more interconnection between banks. There is a lot of more finance coming from foreign investors. And then there are the complex products, which aren't really related to anything in the real economy. They're based on other financial products. So that also adds a layer of complexity. And so when you get to an extra level, all these extra complexities, the behavior of the financial system is going to be different. It's starting to change. And when there's a lot of interconnection, what you see is that the system is starting to have its own kind of behavior. I thought this was a very interesting picture. It's from Nature, but it's about the financial system. It's the Fedwire system. So it's interbank payments. And what you see is there's a strong hub, as you can see, a lot of interactions here. But what I've found also interesting is that it almost looks a bit like a brain. So I'm not saying that the financial system has a consciousness, but it is, I think, very illustrative of what the difference is between a system and a collection. A collection is the sum of its parts. A system is more than the sum of its parts. There's some extra behavior, and that's why you keep getting surprised by it if you don't look at things, taking into account the interconnectedness between them. Because when something is more complex and when things are so interconnected, you get a lot more dynamism. So again, here, this is again that same period, here, same thing. It really made sense to assume a certain kind of constancy here. Here, not so much anymore. And this is where we are today. So today, if you wanna have a grasp systems, you have to let go of these assumptions of linearity, independency, and really any kind of constancy necessarily. That also means that you have to be humble, because once you found a solution that works today, it might not work anymore next week. So you want to be humble enough to constantly be in touch with issues when they emerge and be able to respond to them quickly. So that brings us to systems thinking. That's where I ended up. Ultimately, to be better at my job is that if you look at the events, you're going to be reactive. You're going to try to look at just the event and then find solutions, but probably there's a pattern underlying those events that's causing them. And then there's something underlying that pattern, and that's the systemic structures. Events are very easy to see, and they're also easy to quantify. Structures, not so much, but that's actually where you have the most influence if you can get it. So this is from a quote from the World Economic Forum from 2 years ago. And as they say, humanity has become very adept at understanding how to mitigate conventional risks that are isolated. But we're not yet competent when it comes to dealing with complex risks that are interconnected. But these are the systems that underpin our worlds, right? Our economy is a system, society, the environment. And when these risks materialize, they cascade through the system. So it's not incremental damage, it's not linear. It might be one of runaway collapse. In finance, we call that contagion. You know, something happens and it spreads through the entire system. And then it's very hard to mitigate it at that point. This is the World Economic Forum, as you probably know. It publishes the annual Global Risks Report every year. And they also, for that reason, map it in a network. And what's more in the center are the most connected ones and the gravest ones. And you see that for the first time, I think it was this year or last year, environmental risks are seen as the most important risks today. So all very much related to climate change, but also lack of biodiversity. We're basically going through the third wave of mass extinction. Not for humans, but for almost every other species. So that's where our scope is going to broaden now. And we're going to look a little bit more to what those underlying patterns and systemic structures are and what major trends we see and how they are going to impact finance and ultimately your job. One of them is going to be the debt levels that we're seeing right now, and paired with the quantitative easing that Martine is very aware of, what we've been doing for the past decade, climate change for the reasons I just mentioned, rising income inequality, and other social things that come with it. And then ultimately we're going even a layer below the systemic structures, but I'll come back to that. First, we're going to do another question. So again, everything's the same except one thing. In World 1, you earn 150,000 a year, and everybody else earns half. And in World 2, you earn more, 250,000 a year, but everybody else earns twice as much as you. So, who prefers World 1? Remember, all prices are the same, so you will still be able to buy more in World 2.
Raise your hands. Who's in favor of what? So, 1, 2, 3, 4, 5, 6. So 6 in favor of world 1. And then who's in favor of 2? 1, 2, 3.
I'm assuming it's 4.
Yeah, so they're missing. People are a bit confused now. But the majority seems to be going for world number 1. So.
All right.
6 versus maybe 4. Yeah. Okay. That's. Okay. Yeah.
All right. So. I'm going to go into a couple of global risks, major trends that I see. And the first one is still financial. And I think what's interesting to see is that we're at all-time high debt levels. So typically, we know from economic research that high debt levels are associated with crises. And it's interesting to note that in many countries, also the US, private debt is back at pre-crisis levels. And it's not just correlated with economic crisis, it's also correlated with social unrest. So that's interesting. In the US specifically, as you can see, it's back, it's actually at a long-term high. The composition has changed a little bit, so it's less mortgages, a little bit less, it's still the majority. But student loan debts are very high. It's called a national crisis. There are definitely people who, I know several people who went to med school, for example, to be a vet. You're never going to get rich doing that. And they graduate with $400,000 in debt. So it doesn't make a whole lot of economic sense, because these are people that will maybe never be able to buy their own house, or in any way, anything that you pay off for your loans, you're not going to put back in the economy. So it doesn't actually make a whole lot of economic sense either. There are also laws here that the student loan debt is the only thing that you never get rid of. So even when you go into your pension, when you're 65, they will still hold your repayments from your pension, from your state pension. Even when you go bankrupt, you cannot get rid of it. So that's where, for example, you see current primary candidates like Bernie Sanders arguing for student loan forgiveness. But so far, it's pretty high. But it's not just the private, it's not just the consumers, it's also the public sector now. It's been going down marginally, as you can see, but it's still very close to all-time high levels, especially if you put it in a little bit of a longer perspective, like here. This is the federal debt. It's pretty high. This is global debt. As you can see, it has increased a lot. Much of that was also during the crisis. This was the crisis right here, and you can see that it shot up because they were bailing out the banks, and most governments have not recovered from that as of today. It's even worse for the central banks. So they bought up a lot of the toxic assets, so the assets that nobody else wanted to buy anymore, to keep liquidity in the market. So that's what you see happening here. That's why it all shut up so much. And they have been selling off those assets a little bit, but as you can see, in relative terms, not that much. This is an interesting situation because we've never been here before. And theoretically, they could keep buying it because they're printing the money. But there is, of course, the other risks that come with that. And of course, also their main task is to keep inflation low. But the thing is that they're also out of that bullet because the central banks, as you know, set directly or indirectly set the interest rate. But in the ECB, so in the Eurozone, for example, it's been at 0 already. And it's relatively low for the Federal Reserve too. So the point of all of this is it's a unique set of conditions, because it seems like in terms of debt, we're back at pre-crisis levels, but governments and central banks are out of bullets. They're not that strong as they were 12 years ago. And that's why some people say, well, we're not really sure how this is gonna play out if we have another correction coming. And some people say we are overdue for it. You can never predict a financial crisis, but if it were to happen at some point, the government would not be able to do as much as it did last time. So one thing that could maybe, well, at least doesn't help with an upcoming financial crisis is climate change, because simply put, the financial impacts are going to be enormous. There are a lot more impacts than just financial, but only looking at what it will do to our assets valuations and the lack of growth can be up to $43 trillion as estimated by some experts. So that's, for example, also why BlackRock, the biggest investor in the world, said this is gonna trigger a fundamental reshaping of finance. When BlackRock says something, when the CEO of BlackRock says something, that people take notice, and that's a big deal. The Bank of International Settlements, so the central bank of central banks, basically, is also saying this is gonna be enormous. This report's from last month, where they say they called it a green swan. So you know, it's hard to measure the impact of black swans, as you know, because they're so rare, and it's sort of the same for climate change because it's unprecedented. So again, we don't have past data on it, but we know that the impact is going to be huge. I want to put it a bit in a perspective of how it's interconnected with a lot of things. That's the theme of this lecture. The thing is that it's not just that the weather is gonna get hotter, as some people still seem to think. There's climate change is gonna, as the CEO of BlackRock said, it's gonna reshape finance, but it's gonna reshape society. There are lots of interactions with climate change, including social ones. Think, for example, of climate refugees. So you get social issues around immigration, which are never easy. But just environmentally, climate change there will be less water. It will increase evaporation. But also the water demand is set to increase because population is still increasing. It takes enormous amounts of water to generate energy. At the same time, it takes a lot of energy to transport water. Obviously, we need water to grow food. We waste a lot of food and water, about a third in the West we throw away uneaten. But it also goes a lot of energy in food, et cetera, et cetera. So we have all these things that it's interconnected, and climate change is at the heart of it. So if you look at energy, for example, how that's going to impact you, there's the scarcity issue, but probably at this point, the climate change issue is going to be more pressing. Meaning, if we would still use all the coal, especially for coal, we're going to run out of clean air before we run out of coal. But at that point, we will see what all the experts think is runaway climate change. So we can't use all that coal. So then you get to the point of stranded assets. But of course, there's the other side where, does everybody know what stranded assets are, by the way? That's what you already invested in them. There are investments, huge investments in fossil fuel reserves that you now have to write off because you can't actually, that value you can never actually get because you're not going to turn it into energy because of climate change. So that's a lot of money, but there's also a lot of opportunity here, obviously, for investments in renewable energy, which we see major institutions around the world now do. So it's a very interesting time now where you see it taking off, and obviously there's still a lot of risk. At the same time, there's also the risk that if you don't get on board, you will have missed the boat. Same thing goes for water. As I said, the UN predicts that by 2045, majority of the people are going to be water stressed, about 2/3. No, I should say water insecure. And they're gonna be really deprived of water. What we see here is about 40%, which is still a lot. So there's gonna be a lot of interesting things to do in water efficiency, water reclamation, desalinization is probably going to be an interesting area. And then there's, of course, what you also see is that people are now starting to buy up land with water rights. You see that happening in the US. China is doing that a lot, including in your country, buying up a lot of your land because you have, relatively speaking, a lot of water. And then there's the food issue, that because you need a lot of water to grow food, but you also need the agricultural land for that. For obvious reasons that we have a finite area of that, but the population is still increasing, and also the kind of food that we eat is increasing at twice that rate. So meaning what we mostly what that means is that you see people's diets change, especially in upcoming economies. So they want more meat. That's considered a luxury still. But it takes so much more energy and water to grow meat than it does other vegetables, for example, vegetables and grains. So it's very interesting that the number of people who are undernourished is actually going up again. I think that's a very interesting statistic, given that at the same time, we throw away in the West about 1/3 of our food. So that actually brings me to the next issue, which is income and wealth inequality. You see this rising, income and wealth inequality, you see this rising within countries and between countries. So the rich countries are getting richer on a macro level. And you see that a lot of poor countries are not getting anywhere, they're stagnating. But within economies, within countries, you see that the rich are seeing an increase in their wealth every year, but the middle class not so much, and the poor are actually in purchasing power getting poorer. This is a very interesting thing that in systems thinking, this is the kind of causal loop diagrams that we draw. We see how things cause each other. There are a lot of these. This is a successful archetype, which basically means if you started at a good level, your chances of success increase. So you keep getting more successful, but the others can't get to that level. So you see that, for example, because return on investment is higher than on labor. So if it's very hard to save if you get your income from labor, but it's harder, relatively speaking, than if you get your income from investments, which of course only happens if you're wealthy, because the return is higher. You see this also with education. Typically, when you have higher income, you can afford better education, and when you've had better education, you get a better paying job, which means that the next generation can also afford better education. Not so lucky if your parents did not have a high income. Same for health levels, for example. If you're healthy, you perform better, you can get ahead in life, and then when you have a good paying job, especially in a country where that's not healthcare is not guaranteed like the US, but then you have a good job, you have health, you have a good healthcare, you can keep performing. It's very hard to keep performing if you're not healthy. So I already mentioned that America is one of the starkest in this sense. So let's see, we have, as you can see, the Gini coefficient is a common statistic used to measure inequality. So US is right up there together with Turkey. My home country, the Netherlands, is a little bit lower than, let's say, most. New Zealand is here, so you're also relatively high, in the middle. And here too, it's been increasing. I think the middle class, the share of the middle class is really quite low in the United States, which is interesting because that's really what the economy is based on. It's if you have a good, healthy middle class, you have a more stable economy than if it's balancing on if you have a poor community and a couple of ultra rich people. if you compare it to the Netherlands, for example, where it's only almost half, it's really quite low if you look at that compared to other countries. And as I said, what you see is that there are so many channels, social, environmental, all kinds of, and economic, of course, that make that high income inequality is actually not good for the economy. You hear a lot of theories about trickle-down economics, but the truth is that empirical studies just find no evidence of it. If you look at the times when tax cuts were given, it just didn't trickle down. There's enough data on it now that we can say that, and it actually makes sense if you think about it, because it's really the middle class that is the true job creator. So people who are, if you're the head of a company, you really only hire people when you absolutely need to. Your job is not to create jobs, and so you'd only do it if enough people are buying your products that you can't keep up with demand. But who is buying those products? It's the middle class. It's not the poor because they don't have disposable income, and it's not the ultra rich just because they just put it towards luxury vacations and Russian collections and offshore accounts. So, but that's the financial part of it, the economic part. But what you also see is that there's a lot of behavioral psychological studies now that show that there are a lot of it basically breaks down social cohesion between people. So crime rates show a much stronger correlation with income inequality than with this length of punishments, for example, severity of punishments. There's not a strong negative correlation. It's mostly when you have a high income inequality that crime rates tend to positively correlate with that. And even when, apart from crime, what you see is that there's more social unrest and that there's less trust between people in general, and there are other social inequalities that you also see, like racial, all kinds of discriminations, basically. So in economic terms, the transaction costs go up because people are less trusting of each other. And then lastly, what you see for some reason is that environmental conservation efforts go down with higher income inequality. And the theory is that it is because when there's high income inequality, there's a lot more, people feel more pressure to show that they're of a certain class because there's so much difference between it. So there is more display of material wealth that goes at the cost of environmental protection. So this is what the OECD did a study, an empirical study, and they were very clear on that. They said sometimes they measure the impact of inequality. Typically it's negative, as you can see, the orange bar is negative, including in your country, it's quite a big negative bar actually, and the US and the Netherlands, Martina Mai's country. There's some Ireland here, and there's a small beneficial effect in France and Ireland, which by the way are already quite socialist countries. So I think what you can see from this is that there's probably an optimum of income inequality. You want people to have an incentive to work hard. So there's nothing wrong with that, but there's definitely an optimum, and after that it really starts to it doesn't trickle down anymore at all, basically. And in most countries we've gone past that point. Another thing, and I already mentioned this, what you see is there's quite a strong correlation between social unrest, so discrimination, and then ultimately this goes to populism and xenophobia. You see that very strongly. You see a rise again of extremism in that sense, and it's quite high these days. It's around the same level as before the Second World War, according to Deutsche Bank. And this is a report from Deutsche Bank, and they said this is a very strong correlation between income inequality and populism, and it's not going to be good for business. This is a causal loop diagram that we're not going to go through this too much, but it's just to show that income inequality is a very complex problem with a lot of environmental and social and behavioral and economic issues that all interact. For example, I didn't go into it how it damages democracy, which is something that Piketty is a very well-known economist that works on income inequality. He studied it very thoroughly, and he said one of the key things that it does is that it erodes democracy. For the obvious reason, it does so bottom up because of the populism that I just described, but it also does it top down because when you have these ultra rich, it's relatively easy for them to lobby and almost buy politicians. So that brings me to, I think I didn't mention this at the beginning. I think I had it written down, but I didn't mention it. So when I was working here in the US, and I was looking at the economy, and even before when I was working in finance, I noticed that some things weren't priced in. I thought it was, at some point it became painfully obvious that markets do not, that sometimes you have market failures. And I noticed that especially environmental costs were not priced accurately. Water, for example, given the upcoming water scarcity, some people call water the new oil, yet it's so cheap still. And for that reason, it's still wasted a lot. But obviously the impacts from climate change, all those things. So that's why I went back to school, to Harvard, to study sustainability. And what I did my thesis on, and I recently, I only graduated recently, is on the limits to growth model. So that's a model, a systems model of the world. It's the first systems model of the world, and it was done by a group of MIT scientists in the 70s already. And I thought, that's interesting, let's do an empirical study. So what I found is that with the systems model, they created certain kind of scenarios, and these are two of them. This is the scenario where they assume business as usual, basically. This is the scenario where they assume unprecedented technological innovation. I found that these two scenarios line up with empirical data very, very closely. I was very impressed with that because I don't know, I've seen a lot of models in my time. I don't know of a model that forecasted this accurately for decades into the future. So I took empirical data on population, pollution, etc. And what you see is that we are here now, 2020. So far, these show a similar, basically the same development, which is why I could not distinguish between them yet. But they show a very different development after that. So the business as usual one shows basically what they call the ecosystem breakdown. And it's a scenario that's closest to climate change. So what they say is at one point, the pollution, which in this case I approximated with CO2 levels, will be so high that it just starts, that it causes collapse of the economy, and also will cause mortality to increase again. Partially also because we can't grow enough food. Now these are a kind of thing that are predicted, that climate change will diminish our ability to produce food. But a lot of people argue, yes, but we have innovated ourselves out of constraints in the past, which is true. And so that's why maybe it's this scenario where we have unprecedented levels of technological innovation, and we are, with just a little dip maybe in the 70s, 2070s, we're going to be okay. The point is, I'm not going to go into how realistic the assumptions are in this scenario, but I do want to point out that in both cases, even in this one, we stop growing. We do see a halt in industrial output, which is stands for the economy. We're not going to be able to keep growing, showing a GDP growth every year. And that puts these messages that we see, these are just from this year. We see this everywhere. Growth is slowing down. And then everybody is talking about how is this possible and what are we going to do to kick the economy back into gear. But maybe that's not going to be possible anymore. And then we have to find out new ways to give meaning to our economy. So that's the next level of that I mentioned. We have events, we have patterns, we have structures, but beyond that really is our mental models and our vision. So we can, this is where you're really impactful, where you can generate entirely new scenarios. And that's what I'm going to go into, solutions at these kind of levels. I'm going to go into tools and methods, but also in changes in our mindset and goals and values. So tools, the ones that I'm using and that we're using at KPMG now with our clients is, I hope this is obvious by now, we look at events in there and we take into account their interconnectedness. So we create the network and see how things flow in that network, what the characteristics are. This is not going to be as precise as a 99% certainty, but I would argue that anybody, outside of a controlled experiment, outside of a lab environment, that is someone who promises you 99% certainty is overpromising, because that's not the kind of world we live in. There's no such thing as 99% certainty in this world. So it's better to be, I think, forward-looking and accurate than precise. So tools that we use for that method is expert elicitation, which is comes from the U.S. military. In the 50s, they didn't have data, so they said, they came up with a new way to get to information in the absence of data, and that was expert elicitation. You take a group of experts and a diverse group, and then you aggregate their input, and that's the best predictor in an uncertain environment. One, no matter how genius expert is about as accurate as a dart-throwing chimpanzee, we know that from studies, but a group of experts is the best predictor in most situations, save a lab environment. Scenario analysis is, I think you're familiar with that, is very, that's the TCFD advises to use that to model climate risk, for example. I would say that that is not the same as a Monte Carlo simulation, because with Monte Carlo, you use a random generator to randomly vary one parameter or a set. That still assumes a certain independency between those variables. So you really want to create a narrative, internally coherent story, ideally using expert elicitation, where you think, yeah, that could actually happen. And then you can apply network analysis, which is what we do. The most advanced is the system dynamics modeling, which is the model for the world that I just described is a system dynamics model. It's a subfield of engineering. Lots of stuff to do in there. It's very interesting. There are links in here. I think you put it up on Blackboard, right, Martine? So you can click on that, and then, or my email address is at the end. So I'm happy to share that if people are interested. But so this is basically what we do, KPMG. I'm not going to go into that too much, but we basically take this this likelihood severity plot, and we add to that the network view. And the reason we do that is because, for example, normally you wouldn't look at this because it's low risk and low probability, but that's those black swans or green swans maybe. So if you put that in a network, all of a sudden you can see that this one triggers this one, which triggers this big one. And really, ideally, this is what we would call a root cause. So by itself, it's not so significant, but its impact in a network actually makes it very significant. And you always want to be working at the root cause, because here at the end of the causal pipeline, that's where the impact is already big, and it's much harder to stop it. So that's what I do at KPMG now with all kinds of at the UN Symposium about how countries can use the network analysis to map how the Sustainable Development Goals interact, because there's a lot of interaction there too. And right now, all countries are basically behind. They're not on track to achieve the Sustainable Development Goals. And I argue that it's probably because they're working on them in isolation, but you want to be able to optimize to capitalize on their interconnectedness, so you can get those synergies between them. So this is where we go into the mindset. Those are tools and the methods. But really, I think that the future of finance is going to be different from what finance was in the past. I think your baby boomer colleagues, they were really able to still get ahead by feeling like a lot of social issues are not theirs, are not their responsibility. And I think ultimately, long-term successful financial institutions will have to integrate a lot more of these externalities. So you can think of how can you adapt to a more fragile business environment amidst income inequality that is rising. Is there anything that I can do to counteract that trend? And of course, where are the opportunities in there? Because there are opportunities. And one of the things is, for example, and this is not going to be an entire comprehensive list, because ultimately that's going to be your job. But what you see happening already is the underbanked or the underinsured, that in fintechs, for example, they use technology to drive down costs per client. And then they can have the what they call the bottom of the pyramid solution. So people whose financial needs go unmet because they're not interesting enough, they don't have they can offer only such a small margin. But if you can drive down costs, there's so many of them that there's actually a lot of money to be made if you can make that, if you can really cut costs. And some of these like Aetherisks offers crop insurance. UNIQ uses a very technologically advanced form of IDing. That's part of opening a bank account, right? So it's way easier to do, and then they can offer those very low cost bank accounts. So that's when you're more on the customer side, and of course there's the investing part. So at this point, it's no longer an issue of whether you can or should do it, because it's as the UN Financial Initiative said, if you as an investor do not incorporate environmental, social, and governance issues, you are failing your fiduciary duty. You have to take these things into account because they are drivers of performance. There are so many channels through which this works, and there's not enough time to go into them. But for example, if you want to be viable in the long term with your product, well, a growing number of consumers want to buy from green companies. And there, of course, and then there's the thing of attracting and retaining talent. Increasing amount of people just don't want to work at a not good company. So this includes their environmental footprint, how they treat people, of course, and but also things, more governance things like the inequality between the salary that is paid, those sort of things. So I took this from, this is the social responsibility index. So these are the social companies, and then just the traditional market benchmark. And as you can see, it slightly outperforms the traditional benchmark. And I think there's still this very persistent misconception that sustainability is expensive and the opposite is true. That's, for example, why last month only Goldman Sachs said we're only going to take diverse companies public, because we just see that Goldman Sachs, very smart people, they just see in their empirical data there's just such a difference in how these companies perform if they have undiverse boards, and a proxy for that is all male boards. They say we just don't do it anymore because you're just not performing as well. And then ultimately we've got the tools and the methods and the mindset, and now ultimately, as we hopefully segue easily into now, I think we should change the goal of our entire economy. So that's a pretty big statement, but I also think that at the same time, not really, because I don't think we have any other choice. So I published this at during the World Economic Forum in Davos. We had KPMG had a with live blog, so I posted that. Because I don't think there's any other chance. And this was already predicted by the way that climate change would slow down growth. It seems to be happening. And also, and this quote is from the founder of dynamic systems modeling. And he says, it's ultimately growth is not, we think it's the solution to everything, but ultimately it's the problem. It's the cause of all the problems that we see. The thing is, I think this was the thing with growth is that we can innovate out of some constraints, and we have done that, but we will bump into a new constraint. And I think that's the key thing when you pursue continuous growth on a finite planet. Yes, we will with technology maybe resolve the resource scarcity issue. In the 70s, people thought it would be the resource scarcity. But now we see that, okay, so we innovated out of that constraint, right? Because we got oil, and we got all these fossil fuels now from deeper and more dispersed sources. But now the consequences of that is that we destroying local ecosystems more, and we're creating more pollution. So you will always bump into some limit at some point, for the simple reason that we live on a finite planet. So this is why I was asking those questions. Because the goal of growth is very deep in our psyche, in our mindset, and we take it personally. So we have, for example, this is actually a relatively rational group, which you would expect, so that's good. Most of the time when I ask this question, actually a lot of people prefer world one in question one. You are more rational because you notice that $50,000 now is always better to have now than tomorrow. There's nothing here says that you have to spend it immediately. So you could, if there's interest, you don't know, the question doesn't say, but it's always better to have money now than in the future. So you could have the $200,000 now, save that $50,000 and have the same outcome. But I think a lot of times when people choose world one, it's because they would feel, but when asked, well, why did you do that? They said, but I would feel like a failure a little bit if my salary would go down. You want to see your salary go up every year. And certainly not go down. Like if it stays the same, okay, but if it goes down, we take that personally. We take that as of our value, of how we value ourselves. And that's the same thing with the second question. You know, it really doesn't matter so much, although you were still really 6 to 4 is not a very significant difference. But you rather have less money if everybody else has less. And it's again that very relative thing of where you just want to have more than the rest. It really doesn't matter about how much you have in realistic terms, in material terms. It's about having more than the other. But if everybody is always going to have more, we're all trapped in this race of seeking into eternal growth. So you see trends emerging already. I'm probably the first one to say this, that say we should change our definitions of and change our values really with that, but our definitions of growth and wealth. You know, growth shouldn't be just expansion of the economy. It can also be development, self-actualization, that sort of thing. Wealth, same thing. It doesn't have to be material. It should be experiences, right, or knowledge. Success and power. You see this very clearly, I think, in the tech sector. Although you see a very interesting mix of it, but competition and domination, that really used to be the model. You wanted to be the biggest, and you want to dominate your competitors, and now you see more that companies are more focused on being agile, influencing. You see that on social media. You're not telling people what to do, but you're influencing them. You have a lot of power with that. And recreation could be from material consumption to more playing and social interaction. And that's what you see, again, what you see happening already in the business, but also with your own prime minister, who says, yeah, we're gonna measure not just economic well-being, but if our people are happy, Bhutan has done that for many, many years, where they have a national happiness index. They want to see that grow, and they don't bother about their GDP so much. Europe is starting to do that as well. They have this quality of life survey where they measure levels of trust and private work balance, how healthy they feel, all those kind of stuff. It's very interesting, I think, that what you see in a few studies that so far we've seen is that even companies that say our purpose is not just profit, they actually tend to perform better in the market. So it's very counterintuitive. So it doesn't mean that you taking a different goal than growth doesn't mean degrowth. It doesn't mean you go back. It just means that you're it's just an attitude of a growth. You're indifferent to it. And if you're indifferent to it, sometimes it still happens. You see that with, I think Tesla is a prime example of that. They released their patents basically saying, listen, if you copy our engine, it's fine. We're not going to sue you, which from a traditional business perspective is really odd. But Elon Musk said, well, our goal was actually to transform transportation and to combat climate change by electrifying car mobility. So if we find a solution to that and then put landmines around that solution so that it can't spread, we're actually working in contrary to our own goal. So that's a very good example of someone who says this is their goal and not profit. But at the same time, the Tesla share prices have tripled since their inception. It's almost at the highest since inception. I think today they actually went down a little bit. So I don't know if that's true, but they're still doing pretty well. I think Elon Musk is fine. So that was the presentation. I hope you're optimally confused, which is always the best you can hope from these things. But if you would like to discuss any more, would like any more information, my LinkedIn is there and my email address is there, and please let me know any questions you have.
Any questions from the audience? Yes. Yeah. So Yuri is one of our students. He has a question. So go ahead. I think. Yeah.
Should I come closer? Can you hear me?
Yes.
Right. So I have a question. I'm pretty sure quite agree with what you said about the environmental and social factors which are affecting us all, and we have all of these limited resources. Just a quick question on the growth. So you said we need to step in this low growth area. Does it mean like we have to shift more from like material goods into the services where we have more into education, more into knowledge? I mean, would it be like a transition from more like materials like home, cars, equipments, devices into more self-development? So it's transition from being a market which goes from goods to the services.
Yeah.
Is it like a possible solution, or?
Excellent point. Yes, that's exactly the solution. That's I can't go into that much, but I did put here my the LinkedIn. It's a 5-minute read, which is basically exactly what they said. They actually had a scenario in here that shows no collapse at all, and that was called the stabilized world, and that's exactly what they assumed for that. They said, and this is not just Limits to Growth team that made this model, but it's been repeated many times now by a lot of researchers, that they said we need to consciously shift our focus from material, so from industrial output, to services. And they have a variable in here as well for services. So that was exactly as you said, health and education services. So again, it's not at all that the economy would stop working. We would just shift our priorities. So we would make a conscious shift away from material production, but towards education and health services. They were, I think, for some that was very controversial, where they said they also assumed perfect birth control, because that's also a growth factor, right? They said if we have perfect birth control, at least we don't have people being born that are not wanted. So that's a very natural way to slow down population growth. So that's the key things that they saw in there. A conscious limit, a cap on industrial output, shift towards enormous prioritization towards education and health, including birth control. And then also you saw that in their assumptions on the technological innovation. So innovation would also be focused on efficiency, waste reduction, that sort of thing. Because that's the other thing, when you talk about goals, one reason I think that the technological innovation scenario is a bit optimistic is because it assumes that that's where the technological innovation goes towards. But ultimately, all these things, they go towards what the goal is. So if the goal is still GDP growth, technological innovation is gonna give solutions to further that goal, and that's exactly what we have seen. We've seen more resource efficiency, of course, but we've seen most of the innovation actually go to better, deeper, wider extraction of fossil fuels.
Sure. Any other questions, or somebody else with questions? I have one question myself, is that in all these forecasts, the growth of technology and growth of patents and so forth doesn't really feature very highly, whereas we're just one step away from developing, say, fusion energy, or some breakthrough in energy or water treatment, or the the extraction of more clean water. So given that many people are being better educated than ever in the past, you would expect at least that technology would counter some of these trends, is it?
Yeah.
You're painting a very depressing picture, but on the other hand, technology and technological development are a fact as well. So.
Yeah, no, and that's a very often stated argument. The thing is, nobody really knows what's going to happen in the future, so it's easy to make. And like I said, I think a lot of technological innovation, it is focused on that. It's also focused on maintaining the status quo. And I think it's highly optimistic to think that that's where it would come from, because, like I said, we will almost certainly find technological innovations to certain constraints that we have. But in a closed system like our planet, there will be a new constraint, a new limit that emerges as soon as we do that. Let's say we were all going to nuclear energy. Well, we don't have fusion yet, we only have fission. So we're gonna run out of uranium very fast at that point. So that we're gonna have a new limit there. But maybe we finally invent fusion. Maybe, but we've been saying that for quite some time, right? It's not certain when that's gonna happen. Really, I think that's hoping for something where there's not a lot of guarantee, but at the same time, it's true that nobody really knows if that's maybe it is true. I think it's a risky bet.
Yeah. But following on that also is that so in New Zealand, meat consumption dropped by 30% over the last 3-4 years, or maybe 5 years. So people are changing as well. So people are willing to change their habits. Most people quit smoking, I think, 10 years ago, and nobody smokes now. So meat consumption is down, and so there's. I find it always remarkable how people are willing to change if they see things in their environment to respond to. So it's
You're absolutely right, and I think that's one of the key points of this lecture, right? Is that there's no constancy. So it's very possible that it doesn't mean that where we're going now is the way that this development is showing is how we're continuing to go. It's not necessarily a bleak picture, because it's certainly not a forecast. It's a warning. So once people see this, of course, the hope is we're going to make the necessary changes. We totally have the technological capabilities to do it. And indeed, people have the power to do it because they can change their behavior very quickly. It's just that so far they haven't done it yet, not on enough scale, but it's totally doable. Completely agree. And of course my hope is that we will do that, and that's also ultimately was the conclusion of my thesis was we still have time to do it, but it's like the window of opportunity is closing fast, because we're basically right on the edge of where these scenarios are still the same. So if we want to choose the bottom one, we should do it now.
Yes. Okay. Let's do that. Any other question? More questions? Okay. So I'll call it a day. Thank you very, very much, Gaya, for your great lecture. Always nice, because I'm teaching the standard palette of risks: credit risk, market risk, and whatever. But banks, you know, if they want to survive in the future, they have to deal with these risks as well. You know, if they're financing long-term projects, they need to know about this. You know, it's not only about the standard, whatever Basel identified risks, but these are the trends going forward, and also, you know, it puts banks to thinking about how to deal with things like climate change. I heard that the Bank of England now and other banks will start incorporating climate stress as part of this stress test. So you see that the financial sector is already developing and sort of dealing with climate risk to make sure that we are sufficiently capable of quickly responding to things that are definitely changing. Last week here was probably one of the warmer weeks in New Zealand. For once, we had a good summer week, but you know, it's there's things definitely changing in our world, and I think the financial sector can contribute. So thank you very much for the great lecture.
You're welcome.
I'll give to you for later on.
All right.
But any other questions, remarks? No. Okay. Thank you very much.